might start with Rio, just more of a highlight with earnings season almost upon us, and always looking at the potential for the big guys to do capital management and things like special dividends. So on that front, I think we're in really good shape. Rio did put out a really solid quarter in terms of its iron ore performance, which is critical to its earnings. So just a quick recap on what makes up Rio as a business. 2 years ago, 2/3 of its earnings were derived from iron ore. That's now surged to 82% of group EBITDA in calendar year 19, and purely based on the growth in iron ore, not so much shrinking of its other segments. So the rest is split between aluminium, copper, and alumina. So and a few other bits and pieces, but really that means that if we're looking at what potential it has to pay out or have excess cash flow that it can then pay out, we're really looking at how iron ore is performing. So really reassured by that strong performance in Q4, that they did come in line with guidance and really healthy received prices there. So I'm predicting or forecasting a final dividend of US $2.93, which is on its way to being 40% bigger than the first half. They do have a tendency of paying out more and announcing bigger buybacks in their final half. So Feb's going to be hopefully a really positive quarter for Rio, more so than BHP, where it's an interim result and they've got less iron ore as a percentage of their mix. So the stock has obviously performed really well with the rest of the iron ore stocks. But iron ore still at $95 is obviously an exceptionally good price. But longer term, I don't see any real barriers to any production coming back on, and really hearing a lot of chatter in the industry already of old assets being brought back online because now they're vastly economic. And there's certainly don't see anything that's going to hold back supply from the big miners. So Rio are guiding to significant production increase next year, or this year, I should say. And I think we're going to see similar out of Vale and BHP, who also obviously had hampered 2019 performances in iron ore. So Rio's trading on an EV/EBITDA of 5.8 times. I don't always look at multiples in resources, but it is interesting sometimes to compare what's driving them. And that compares to the global peer average of 5.3 times. So certainly not expensive when you consider the quality of their earnings, the state of their balance sheet with gearing at just 15%, real minimal capex requirements, big cash flow generation. So even with iron ore set to moderate in my forecast, I'd have to say the quality of the earnings are really supporting an elevated share price anyway, along with the dividend profile that looks on track to be above 6%. And really, when you compare it to what else, when I say global peer average of 5.3 times EBITDA, I mean, you've got the likes of Vale, who have a big raft of issues, obviously in Brazil, following the tailings dam collapse, or multiple tailings dams collapses they've had. They're on 4.6 times, Glencore on 5.3 times. Even the big copper names are quite elevated as well. It's just very hard to find bang for buck in large cap global mining that really looks more attractive than BHP and Rio, even though I'm struggling to put them on a buy. So what I'm really saying is that they're a really strong hold and you're going to get a good dividend along the way. South32, which is certainly at the pointier end, in stocks that can move with their underlying commodities, earnings really move quite violently sometimes because it is a lower margin business, but it is significantly diversified. So while Rio might be 82% iron ore in 2019, South32 actually has a really nice even split between aluminium, which is 26% of revenue, alumina 23%, manganese 19%, thermal coal 17%, met coal 6%. So just really nice spread across different markets. The issue for South32 obviously has been that a lot of those markets have been really depressed, slowing manufacturing activity, slowdown in China, coal markets dragging, all those sorts of things have been weighing on them. But the reason we upgraded a few months ago, or 4 months ago, is that we did see some good upside, or at least a significant amount of that downside now being reduced. So, or near floor levels. So we've kept our target, which is 20% above the current share price. Really, when you look at my forecast, we have earnings jumping away really quite quickly once you get into 21. And that is commodity price driven primarily. So that would see South32 drop from an EV/EBITDA of 6 times this year, or in 20, to 3.4 times in 21. But if we don't get that commodity price recovery coming through, it'd still be on 4.8 times before you consider stripping out the South African energy coal business. So once you do that, then the quality of the earnings profile really takes a big jump up again, and that hopefully will close later this year. So very happy with our call to buy South32, and very happy with our solid hold on Rio.